So welcome back. We're talking about the daily range price action. And the daily range is defined by the open price, the low of the day, the high of the day, and the close price. So when you learn about candlesticks, you have to understand that for every candlestick, for a bullish candlestick, for instance, bullish candlesticks opens down and closes up. Now, the thing that we need to add to this is the high and low of every day. When you hear high of the day, low of the day, imagine this candle to be a candle in the daily time frame. Now, in the daily time frame, each candle represents every day. So, in as much as here is the open of the candle and this is the close of the bullish candle, what about these weeks? What are they called? This is called the high and the low of the day. Now, it's not inverted the way the open and close is inverted for the bearish candle. It's the same. This is always going to be the high and this is always going to be low for any candle, any color, bearish or bullish. This is a vivid example. As you can see, this is open of the bullish candle, this is a close. And for a bearish candle that's in the daily time frame that is representing a bearish day, this is open, is inverted now, and this is the close. But see the high, which is the wick, and the low are the same for both bearish and bullish day. So we have three major sessions: the Asian sessions, the London session, the New York session. Now these are times in the day whereby trading volatility is really high and it's really volatile, best times to trade and everything. So you're going to learn about the Asian session first. So let's continue. Now the Asian session is characterized by being a consolidation of 20 to 40 pips due to the lack of liquidity in the market. Now Asian session is usually called Asian range most times by traders because this session is always ranging. The market is literally not doing anything. It's just going up and down, up and down. It's not expanding higher or lower. This is called Asian range. Now, in Nigerian time, it starts 12 a.m. and ends 6 a.m. Nigerian time. Now, at this time, most traders are sleeping in Nigeria and are not doing much. Are sleeping and are not doing much because of lack of volatility and the rest of them. Most traders don't trade Asian session in Nigeria. Okay, most traders avoid the Asian session. So let's go to the next London session. So before we go to the London session, this is a vivid example of how the Asian session looks like. As you can see, it's highlighted in yellow, which is really a range. Really a range. As you can see, other parts of the market is moving, but this is still a range. All these areas highlighted yellow are good examples of the Asian session. The London session is characterized by making the low of the day and the high of the day. It can be used to take traders to the opposite side of the true direction of the day because of liquidity. Now, the word liquidity, don't stress over it. Don't panic. The next video is coming. Liquidity is going to be very much explained. Okay? So, liquidity is just the way whereby the big players in the market make their money. Whereby how they use retail traders as baits to make money. That's liquidity. Without liquidity, the market literally is not going to move. So, the market moves up, down because of liquidity. Okay, and this liquidity is money that is in the market. In the forex market, somebody has to lose for somebody to win. So the big guys hunt the smaller guys, take their money, and that hunting is them pushing price from one level to the other, and that's how we see the market move up and down. Okay, so when the market, we say London session is characterized by making the low and high of the day, means London session really expands. But when it expands in one direction first, then reverses. It likes to expand from the Asian session, expand to one direction, either higher or lower, but then start reversing after doing that. So when it expands higher first, it tends to go and make the high of the day before it starts retracing. When it expands lower first, it tends to make the low of the day, which is that wick you see on top of the daily candlestick. Now this is an example. After the Asian range, London session started and it went straight up, and you can see after retracing, the market never got there again for the rest of that day, and that's why it made the highest point of the day, high of the day. Now, as you can see, this is an example. After the Asian session, London session started and price moved down first before it moved up, and that's how it made the low of the day. The market did not come back to this low. for this whole day. This is an exact example. Asian session highlighted yellow, price moved down first during the London session and then retraced from there, and that became the lowest point of the day. These are real-time examples. Now, the New York session. The New York session is characterized by being a retraction after the London session made the high of the low of the day. Sometimes the New York session can make the low or high of the day too, meaning retraction is after the London session has expanded to a particular direction and does something like a fake swing or whatever, or a Judas swing, as you call it. Yeah, the word Judas swing, something fake, a fake swing where the market moves in a certain direction and every trader will think it wants to start going up, but then it starts reversing from there. That's Judas swing. Okay, so in a situation whereby this happens, the New York session, when it comes in, New York session tends to continue like that, or still go and make another high for the day or another low for the day. Okay, so the New York session is a very tradable session. So what time is the New York session? Let's go back to the London session and look at the time. Now, the London session starts around 8 a.m. Nigerian time. Okay, it starts at 8 a.m. Nigerian time, from 8 till 5 p.m. Nigerian time on default. Okay, from 8 to 5 p.m. Nigerian time on default. Mind you, the way when the London session is on, the New York session normally meets it, what they call overlap. Now, around 2 p.m., the London session starts. Now, this Nigerian time I'm talking about is UTC plus 1. So around 2 a.m., the 2 p.m., the New York session starts. Now remember, the London is still very active. So therefore, when the London is active and the New York starts, there's an overlap, meaning around that time there's high volatility. And that's because there are business transactions going on between these two countries. So the volatility in the market will be increased. But then that is exactly the time that the New York session starts, 2 p.m. and the London is going to be still active till 5 p.m. So this between 2 to 5, the volatility is very high because two sessions overlap and are active. That is it. So let's go to New York. So you see how the New York session is, how price it always tries to retrace into the London areas before dropping. So what is the best time to trade? Now, the best time to trade is neither London or New York or Asian. The one that fits where you stay, the one that fits your work schedule. If you're a full-time trader, choose the one that you'll be in the best mental state and without distraction to trade. That's one thing about the sessions. You're not compelled to trade anyone, and no one is going to treat you better than the other. But it's best you look at London and New York. What I do is if I trade in London and I win, I'm done for the day. But if I trade in London and I lose, I'm coming back to New York to take another trade. I trade just max 2 times max every single day. So we have what we call AMD: accumulation, manipulation, and distribution. What's accumulation? Accumulation is the of position generally occurs during the Asian session. Accumulation is characterized by being a consolidation Asian session, but it may not be the Asian session. So manipulation usually occurs at the opening of the London session. Sometimes it can be New York open. This manipulation consists of taking price to the opposite side of the true direction of the rest of the day. Distribution occurs when MMS liquidates or exits their position. So when you look at the daily candle, what AMD actually means is that there will be some kind of accumulation in the market. So I'm going to show you exactly what this means in reality, okay? There'll be something like it in the market for some sort, and then all of a sudden there'll be a move or a breakout out of this, and then you see something like this. So this area is called accumulation. It usually happens during the Asian session, but not every time, but it does most of the time, as the Asian session is known to be a range that does not move. Okay, this is the accumulation. Up here is the distribution. So that's an AMD setup. Now it can happen vice versa too, not just that way. It could happen like this. It could happen like this, drop here, then all of a sudden move higher again. So it's still the same thing, accumulation, but this time the manipulation is down. Manipulation is a false move. Remember I talked about Judas swing. Judas swing is a false move. When price moves in the false direction, like it wants to go up, every trader here is going to think, it's trying to go up, they're trying to buy, and then they dump the market down, so they're going to lose money. And that's the main move. This distribution is the main anticipated move. The manipulation is called a Judas swing or a fake swing. So this one is what? Another accumulation, but price dropped down, and everybody thinks will also sell. But then price all of a sudden goes back up. So that's why it's called manipulation. So yeah. So in the candle, since this is the accumulation for a bullish day, it's going to be accumulation around the open of the candle. Asian session, remember, daily candle is opening at Asian session 12 a.m. So as it opens, it's going to be a range. And this daily candle will still be very small, like a dash here. But then when this candle when this candle opens here, it goes down. That down is what the manipulation. It goes down before it takes off higher, makes the high of the day, and start retracing back down to rest. So that is how this bullish daily candle is formed in most cases. How about the bearish daily candle? It opens like this, like accumulation, Asian session, because bearish candles open up and close down. So it opens up with the accumulation. If you check the smaller time frame, you find out that it's an accumulation, and then it goes up suddenly to create this wick, and that's manipulation on the smaller time frames. And then boom, it distributes even lower, and that is it goes to make the low of the day. That's distribution. It also goes to make the low of the day, and then goes retreats and stops by this. So that's exactly how the bearish candle, bearish daily candle bar, how it is, and the anatomy of it. So this is bullish AMD, what I just showed you. How this is the accumulation, this is what manipulation, and this is distribution. And this is it on the live chart. As you can see, price ran the Asian range, price went lower than it, and then price rallied up right as the distribution higher. As you can see, perfect example. Now this is for the bearish reasons, bearish scenario. This is the Asian range, price accumulated, and then price ran up, and everybody would think it wants to buy, and then price crashed, distributed down. That is a very simple approach: accumulation, manipulation, and distribution. All right, so welcome back. So liquidity. What's liquidity? Liquidity in the market are these areas where a lot of retail traders have their stop loss kept. So what does that mean? Let's assume the market is moving like this and like this, like this, like this. For instance, now what happens is that a lot of retail traders like you and I are trying to look at this area and say, okay, this area is something, price is consolidating around here. They believe that if price breaks out of this, price will just keep going higher and higher and higher. So when they see price consolidating in a certain level like this, what they usually do is wait till price breaks above, then they try to activate what we call buy stops. What's buy stop? Buy stops is a pending order whereby when price gets above this blue line, price is going to just activate automatic buys by itself. So it's a pending order. It will be pending right there till when price touches it, then boom, it gets, as price goes into profit, they start making money. So these happen sometimes, but not often. So what happens is that the market makers will push price this up and then will drop it down so that it can clear their stop losses around here. So liquidity is all about the market trying to chase areas where the retail traders have kept their stop losses. What is stop loss? where the retail traders have kept their stop losses. That is exactly where um that's exactly where liquidity is. Okay, that's exactly where liquidity is, where retail traders have their stop losses kept. Some retail traders also try to sell at areas like this. Okay, some retail traders try to sell at areas like this. They call it resistance, and then what happens is that the market would just move straight and blow up everything, and they lose money. So we are learning about liquidity so that we can be able to spot areas where they push these prices to cause manipulation. Okay, they push prices to these places to cause manipulation. So we have the first type of liquidity called buy side liquidity. Buy side liquidity are areas in the market that there are high areas in the market where prices like to go for to cause what they call a stop loss raid or manipulation or whatever you want to call it. So buy side liquidity can be found around these areas I'm going to be writing down. So these are the buy side liquidities we have. Okay, London high, Asian high, high of the day, previous day high, previous day low, New York high, previous high. So if you check, everything that concerns buy side liquidity is always high, 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 high. Are you seeing it? These are areas in the market. These are areas in the market that they want to reach for and cause manipulation. Okay, so now London high is literally the highest price or the highest point that price reached in London session. Asian high is the highest price that point that the market reached in Asian session. High of the day is the highest point that price has covered for that day. Previous day high is the highest point that price reached the previous day. Previous week high is the highest point that last week was able to get to. New York high is the highest point that was created in New York session. Previous high was just the most recent high before present market price action. So this is what it is. Now this is exactly opposite of sell side liquidity. So now let's look at it. Sell side liquidity is now the direct opposite of buy side liquidity. Okay, what are these areas? London low, Asian low, low of the day low, previous week low, New York low, previous low. So London low is the lowest price is the lowest area that price reached in London session. Asian low is the lowest area that price reached in Asian session. London low of the day is the lowest price that price has reached for the day. Previous day low is the lowest price that the market has reached for the previous day. Previous week low is the lowest price that price has reached or market has reached for the previous week. New York low is the lowest price that the market has reached in New York session. Previous low is the most previous or recent low that the market reached before current price action. So I will show you guys all of this on live chat. Okay, so move to the equal highs and equal lows. Equal highs is very simple. This is equal highs and this is equal low. So it's better I put it out there. All right, so this is an example of equal high and an example of equal low. When price is making something like a M pattern is equal high, and makes up like a W pattern is equal low. So we'll go straight to the chart and show you exactly areas like this for the buy side liquidity and the sell side liquidity. Okay, so let's get right into that. So when you talk about the London high, what you mean? So for you to be able to identify London high, which is what I'm going to start with, how are you going to identify it? You can't identify this on the daily chart since it's London high, it's something intraday. So you have to move to a lower time frame like the 1 hour. So let's get right there. So how did I use how do I write 1 hour on my trading view? I'm on the full screen. So 1 hour is just by writing 1H, 1 hour will show up. So now we are on the 1 hour time frame. So how do we get London low. Today is Thursday, 28th December. So how do you get London low on this chart like this? So you would first of all go to the, I think 15 minutes is going to be better. Let's move there. Okay. So if you check this faint line, you see vertical line here, I'm sure you can see it. And this faint line is demarcating today's price action. So we'll find where London session starts from. London session starts by 9 a.m. Nigerian time. My time is set to UTC plus 1 Lagos. Okay, my time is set to UTC plus 1 Lagos. In case yours does not set, look at it here, Lagos. So therefore, I have to look for 9 p.m. As you can see, my time is reading down 9 p.m. Sorry, 9 a.m. 9 a.m. here. So that is it. That's where it started. Now, between then, when does London session end? London session ends by 5 in the evening. Oh, New York, so it's from that time to when New York session starts. Sorry, New York session starts by 2. Okay, New York session starts by 2. Are you seeing that? 2 at 14 o'clock. So this is all London session. So what's the highest point that price has made in London session is here. That's a London high. Can you see that? And this is the London low. So these two places are called what? Buy side liquidity is a London low. It's a buy side liquidity, and this is sell side liquidity. This is London low, sell side liquidity. This is London high, buy side liquidity. This is an example of it. Okay, this is a thorough example of it. So then go to the next one we listed. Which other one did we list again? Let's rush to the daily. Did I just switch pairs? Let's move to the daily. Okay, we are back to the daily. So the next thing we're going to look for is Asian high and Asian low. So let's go back to 15 minutes. Asian high and Asian low. We're able to mark London. So what about Asian? So Asian starting midnight, which is here. Okay, Asian starts midnight, which is here. But now I think it's going to be 1. It's going to be 1 a.m. not 00 a.m. because everything has shifted 1 hour in front. So it's going to be starting 1 a.m. So I'll use my rectangle tool here to I'm using it to highlight the whole of Asian session to when it's London time. Great. So this is where London starts. London starts at 9 a.m. So I drew it to 9 a.m. there. That's where London starts. So as you can see, this is where it started, right? Now that's Asian. So what's the highest point in Asian? Highest point. Now here there was no high actually until this point when there was a high. So this is the highest point here, and this is the lowest point here that Asian session never made. So looking at it, is that I think is this. So now let's remove our box. Let's see it clearly. Can you see this is Asian high and this is Asian low right here in our front? So have you seen that we have been able to mark out this? This is a buy side liquidity for an Asian high, and this is sell side liquidity for an Asian low. The same thing with New York highs and New York lows. I'm gonna look for it right here. New York highs and New York lows. So New York session starts when? It starts 2 a.m. Starts 2 a.m. till 2 a.m. till 9 p.m. 9 p.m. Such a long time. Yes, that's when New York station stops. Till 10, sorry. That's when it stops. Let's extend it to 10. So it started here. This whole place highlighted in a box is New York session. So can we mark out the highest points created for New York? We found out that the highest points created is this point right here, and the lowest point created is this. So let's move our rectangle so I can see it properly. So you can see it properly. This is the highest point made. You can see it there. I really see there. That's the highest point that was made in New York, and this is the lowest point that was made in New York. So therefore, this is a buy side liquidity and this is a sell side liquidity. Okay, so let's talk about previous day highs, previous day lows, and everything. So let's try to delete a whole lot of crap. Okay, I don't have to delete these things since I will need them. So previous day highs, previous day lows. Now remember I said these faint lines, I'm going to make them a little bit more visible so I can see them properly. I'm sure you can see them properly now. You see these faint two lines right here, they demarcate each day. This is today, this is yesterday. So it's simple. Yesterday, the highest point in yesterday is this. That's the previous day high, and the lowest point in yesterday is this. That's the previous day low. So this is a type of buy side liquidity, previous day high. Buy side liquidity, this type of sell side liquidity, previous day low. Are you seeing it? Neat and identified. Good. So that's a type of buy side and sell side liquidity. So let's move to the next previous week high. How do you get previous week high? You don't stay on the 15 minutes to get that. What do? We stay on the weekly time frame to get that. Okay, so go to the weekly time frame. Good. So go to the weekly time frame. I'm using a full screen, so I just have to write 1W on my screen. So I'll just be at the weekly. So now let's look at what the weekly chart is saying for previous week highs and lows. Now this is current week and this is previous week. So how do you get the highs and lows of the previous week? The up of the candle is the highs of previous week, and the down of the candle is previous week low, and that's it. So identify it, as simple as that. And you can see this clearly from the daily time frame as the buy side and the sell side liquidity. Right here, looking like a candle, but when you're on the daily, you understand it better. So this is the week high and this is the week low, as this is the buy side liquidity and this is the sell side liquidity. So now you have been seeing how to identify these very key points in the market: buy side and sell side liquidity. What are they used for? Buy side, sell side liquidity, what are they used for? Now, for instance, if price is moving this way and price runs the sell side liquidity out of these things we have mentioned, London lows, is it London lows, previous day lows, is it previous week lows, is it previous lows, is it Asian lows? As long as it runs it and closes above, like the candle just through a week and closes above, and it's what is likely going to do is going to expand higher. This is exactly what you're going to learn in few topics to come, but this is like an introduction. So in case you ask me what's this used for, but for now we're going to learn how to identify them. So we'll learn about all of this later. So now this is sell side and buy side liquidity. So let's move to talk about equal highs and equal lows. Equal highs are also buy side liquidities and equal lows are also sell side liquidities. Equal highs is a form of buy side liquidity. Equal low is a form of sell side liquidity also. So don't get it twisted. So we're going to look for times where we had equal highs and equal lows so I can neatly relate to these things very, very well. Okay, so I'm looking for occasions like that where we had them. So when you go to the 1 hour, you will see more cases because this is daily, so things are much more difficult to see. Much more difficult to see. Or definitely see. Okay, so we have an instance where there are equal highs here, meaning this high and this high are equal. And you see that these and these are equal. These are called equal highs or buy side liquidity. So that's a very good example. And looking for an example for equal low, these are equal lows, also called what, sell side liquidity. Okay, this is another wide equal low. As you can see, between this week and this week, it's called what, sell side liquidity. Also, we have another equal high here. Okay, as you can see, also known as well buy side liquidity. So this video should be helpful, and if you have more questions, you can ask during the live classes. Okay, write it down, write down your questions during the live classes. So this is the homework you're gonna go with. Okay, I decided to put homework in every video you watch so that you can easily remember what you've been taught. So the homework you're gonna go with is very simple homework. So this is your homework. Your homework, you have to identify all types of BSL and SSL in GBP USD charts using the time frames I used to lecture on this topic. The second homework is identify two cases of equal highs and equal lows on Euro JPY on a 1 hour chart. So before you move to the next video, identify these and submit these to King Duby on my DM, or any submit this on your group you used to learn. If you're in any week group, any week, is it week 1 or week 2, any group you are, submit it there for review before you move to the next topic. You must make sure your this one is correct before you move to the next topic. All right, so see you at the next topic. So stop hunt. So what's stop hunt? Stop hunt is when price makes use of liquidity, which you have been learning. Now, buy side liquidity, sell side liquidity, equal highs, equal lows. Stop front is when price makes use of this very vital areas in the market called liquidity. So let's assume here was previous day high, and we are right here now. So what happens is this. What happens is this. This is previous day high, and then it's a liquidity pool, and then it's a liquidity pool. So what happens is that this is previously high, price does something like this, runs it through a week and start dropping off. That's exactly what stop point means. So in this case, we don't even care about it dropping off, right? But we care about price going there directly. So price going there to through a week is called stop point, because they believe a lot of traders are putting their stop losses here or are trying to buy on every breakout. So they are going to shoot so much volatility here, and that's called stop hunt. That stop hunt is usually the candlestick wick. The wick will shoot up here, but then the body of the candle will still close below the line. That's called stop hunt, or in short, it's called SH. In abbreviation, it's gonna be tagged SH. So that's an example of a stop hunt. So you can see stop hunt in many ways like this. As you can see, price runs the low. As you can see in this diagram I drew here, price runs the low, and that's it. So that's all you know about stop hunt. Price could run previously low, old highs, old lows. Can also run anything it wants to run, equal highs, equal lows. Okay, but yes, that's actually the meaning of stop hunt, hunting for stop losses. That's what the market makers know how to do best. Okay, let's move on. All right, so answering the question about liquidity, I think I'm going to use this opportunity to explain it first before I do the full analysis. So, liquidity, if the market is doing this, because Wheezy asked this question, that's why I'm making this video. If the market does this and does this, now if here is a BOS, I'll tag it BOS, okay? Break of structure, tag it break of structure, BOS, and then here is liquidity graph, okay? Here's liquidity graph. How? When price broke here, it broke with a week. That week is ready for reversal. Okay, that week is ready for reversal. If this is what happens around here. Now the question is, first of all, would you treat this as a new low? Yes, this is now a new low. Is it a break of structure? No, it's not. It's a liquidity sweep, but it's a new low, and therefore the high that is responsible for this should be marked out as a new high, and here too should be marked out as a new low. Now the third question, if this kind of thing happen, let's say this is a daily time frame, what are you going to do here on the smaller time frame? Okay, all you have to do on smaller time frame is you wait for change of character on the 4 hour, price is shifting bullish, and then keep following the bullish trend on the 4 hour till you get to the premium POIs around here. If you get to premium POIs around here, sorry. So if you get to premium POIs around here, you want to stop looking for buys just in case maybe you want to have a potential reversal. You stop looking for that. Okay, but if it shows like it's failing and it start going like this, then you can now continue buying just because you know that okay, it's trying to come to change trend here. So how you treat it on the smaller time frame is you start trading against like counter trend when it happens, but you stop when you're around a premium PI because it has a possibility of also dropping down too. So first things I talked about, it is not a BOS. That's number one. Is it a new low? Yes, because when it's formed, this high should be accounted as a strong high that led to it. So it's a low. So you're going to record it like that. Okay. Thirdly, how are you going to trade it when it happens? You look for the reversal on the lower time frame. So I'm going to show you an example where this happened. Okay, in as much as it happens like this, remember it can also happen like this too. Don't get it or to say it can also happen in an uptrend too, where this is BOS and this is liquidity sweep. Okay, so the liquidity sweep is gonna be this. I the BOS is gonna be BOS like this. Are you seeing it? So like this now, it's the same thing. When you're trying to trade this part on the lower time frame, you're going to be trading like a reversal during the downtrend move. When it gets to any discount POIs around here, also you want to stop. You want to stop looking for sales just in case sales continue higher. Now it's the same thing here. Now please ignore everything on the left and focus on what's on the right, just because of liquidity purposes. So you see that price ran this as a liquidity. So can you see that on the monthly time frame, price there reversing back down? Now, when it reverse back down to this demand area, and there's a little FVG here. If you can see what I'm doing, let me zoom. There's an FVG here. So these are discount point of interest. If I draw my fib from this low, oh my god. If I draw my fib from this low to this high, you find out that this FVG and this demand is sitting in discount area. Good. They are discount. So before price got to this discount area, this is a monthly like a monthly candle, meaning this is a lot of downtrend move for a long time before price finally got here. So are you seeing it now? This low that caused it is going to be accounted for a strong low that led to this sweep. Okay, that led to this sweep. So it's going to be accounted as a strong low that led to this sweep. You have to understand that. So at this point, the same thing happened here again. Price swept this place. So like I told you, when price does that kind of sweep, you have to find out now from here to here, you have this discount demand. So you have to find out the discount area. So if price come there, you will not keep looking for sales. But while price is heading there, you can look for as much sales on the lower time frame as possible. But then when you find out that okay, the pressure is so high and is disrespecting the point of interest, it could lead to reversal too. Nobody knows, right? The same thing that happened here, it happens. You have to look for reversal. See maybe areas like this. I see areas like this where it's trying to go up, but then you see that it's disrespected it again. So once you see sweep, you have to start trading in the next direction, provided you have an opportunity, um, a bearish opportunity. So what I'll do is I'll to show you how the bearish opportunity looks like also. For example, this particular time when price swept this level. So let's play it to when price does the sweep. Okay, there's a monthly time frame. Okay, that has done this sweep. Let's peep how the 4 hour looks like. Now, can you see now on the 4 hours price has changed direction? Can you see that we what broke internal structure here? Okay, on the 4 hour, can you see as we have broken this? What are the POIs available to trade off? Okay, we have this one available. We have um what else is available? Okay, we have this high is available as a liquidity pool, but price did not sweep it as a liquidity pool. Okay, so what I'll do is I'll wait, maybe price enters here. That will be what is tradable, but this is not a sweep clearly, so you cannot trade it as a sweep. That looks like a an internal break of structure. Okay, so as you kept going lower, now we know that okay, this this was a break and this was a new internal low, right? So when price broke here, we flipped bullish on internals. I getting me? So if the internals does not show that it's breaking, I getting me? We can't take it seriously. But this is the internals, right? What about the fractal? Inside this range, there is another break of structure inside. That's fractal's lowest units of it. And the fractal broke this low, and we had this FVG, maybe, and also a supply too. I think that's where price taps. Maybe this is where price might likely fall from. As you can see, price actually fall from here. This kind of area is where you take, let's assume your you price gets into it now, and to take advantage of it. So look at price got into it. Now how do you refine this POI to take advantage of it? So as it enters here, don't go on the 15 minutes, right? Sorry, 1 hour first to refine what POI is there. Okay, on the 1 hour, you look, we had supply above. Price did not really get into the supply, but price ran a high. Okay, price ran, and also okay, I would have said it reacted to the supply, but supply has been mitigated. So price ran this buy side because it's also included in the whole for our supply. It's still a point of interest. So on the 15th, what if there's no data for it on 15th. But I wanted to show you the entry on 15th. Since it's from a monthly time frame, I'm cooking that, right? So all you have to understand is very simple. That in here there'll be a lot of reversal trades inside here because of a sweep like this. Okay. You check on the weekly, that sweep, you check on the weekly, it's still a sweep. I getting me. So that's how sweeps are used. Potential, it could be a potential reversal point, but you don't know. So therefore, when price has reversed to at least 50% of the range, you want to stop looking for setups, or price has reversed is coming close to a POI, it may be the premium or discount depending on what you're doing, the trend you're working with. That's exactly how liquidity is used. Now, liquidity can now this is when liquidity is used is based on structure mapping. So another way liquidity can be used is like this. Let's say price is trending to the upside and price pulls back and does this and then later runs this low. In this scenario, liquidity is now like a POI. Here, liquidity is more like it's involved in structure and everything. This is very higher time frames. But in this one, you see stuff like this on the 4 hours. whereby liquidity is used as a POI. One, you see it on the 1 hour, 15 minutes, whereby it's used as a POI. You know that sell side liquidity grab leads towards higher prices, and buy side liquidity grab as a POI leads toward lower prices. Yes, you did not enter any higher POI, you just grabbed it and dropped. So that's all about liquidity that you have to understand how it's being related to market structure. Okay. All right, so welcome back. This is going to be very um, elaborate on other blocks. Okay, so what are other blocks? Other blocks are are those areas in the market where the institutions, the banks, where they have orders left. So it's there, and when market comes back to that particular price where they left the orders, the market picks up. Okay, so the other blocks are usually found around areas like this in the market. Areas like this in the market, that's where they're found. And if you notice this drawing, you find out that these areas are exactly where the buys pick up from to continue this trend bullish. You see, when it gets here, it picks up. When it gets here, it picks up. So these other blocks, I know you must have watched this in the market structure video prior to this, but other blocks are drawn as the last bearish candle before an up move. Okay, the last bearish candle before an up move. And since they are found at the origin like this, they are use rectangle to identify them like this. Okay, use what? Rectangle to identify them like this. So we'll go into live chat and show you what it looks like. So as you can see, this is an uptrend structure you can see clearly on US dollar Swiss franc. Okay, so and this is exactly where a high was taken out clearly. So therefore we know that the origin of the of the of the bull run that took out the high is around here. So around that origin, there we have the last bearish candle. That is our order block. As you can see it, we have the last bearish candle. You're gonna draw it, you're gonna add the wick from the beginning to the end. That is what our last bearish candle. I know some of you that are familiar with how we draw other blocks before will be like wondering, but it used to be the biggest. Now there are two approaches to Forex that have the concept of other blocks. We have the SMC and we have the ICT. SMC order block is drawn this way. ICT's order block is drawn as the biggest bearish candle before the bull run. But this is smart money concept. You're watching right here, you're learning right here. So it's only going to be focused on the last candle before the up move. So you can choose to call your own the last biggest or whatever you want to call it, but understand that it's the last bearish candle before the up move in this case. Okay, so that is how it works. So now we have other examples we're going to use. So watch these examples. We have another one here. We have another one here. So all of these are other blocks, as you can see, before each move to the upside, each aggressive move to the upside. The move to the upside must be aggressive and have a break of structure. Okay, it must have a break of market structure to the upside. Prime must break above to cause a break of structure. That is when you understand that this is what do you call it? An order block, right? Or a demand zone. Demand is the same thing as order block, and supply is the same thing as bearish order blocks. Okay, so let's look for more examples. So don't confuse it. We have two kinds of order blocks. So we have bearish OB, which is the same as supply, and we have bullish OB, which is the same thing as demand. Okay, so I can use them interchangeably. So the bullish OB is one we just identified, which is the last bearish candle before an up move. It's called a bullish OB because it's around the origin of a massive bull run. So that is why it's called this thing, bullish order block, because it's around the origin before this heavy run to the upside. So now, in the case of downtrend, okay, where do we have supply zone? So you must make sure price is what creating breakout for just the downside before I identify areas as supply zones like this. This is a supply. The last bullish candle before the drop. This is the inversion, or yeah, it's the inverted way of drawing a bullish order block. This is the upside down. So the last bullish candle before the drop is an order block. We have it's drawn that way. Okay, we have let's find more examples. Okay, so in as much as this is a breakout to the downside, so therefore we have a bearish order block here, or a supply, a bearish order block there, or a supply. Okay, that's how it works. In as much as we have a bearish breakout structure there, the origin of the swing that caused the breakout structure is what we call the supply, or a bearish order block, as you can see. So we have many of them. Now, some of them might fail, some of them might hold. That's not your business for now. Your business is to identify. We'll learn how to use them properly and when not to look for them, when not to use them as time goes on. But right now, all you want to find in a downtrend are bearish order blocks that are found around here, or if you want to call them supply zones. That's all you want to see now. And for an uptrend, vice versa, all you want to see now is demand zones or bullish order blocks. So you don't care if price is trading back into them or if price is reacting off them, because in reality, why we are drawing this is because we expect price to return back to it and drop. But you see scenarios where price would run it, fail it, or scenarios where price will get very close and drop. So don't bother about those things. Your job is to just learn how to identify it for now. Later in this course, you learn how to use them very well. Okay, so we have more examples of bullish order blocks here. More examples of bullish order blocks here. These are bullish order blocks or demand zones. More examples of that here. More examples of that. Yeah, as you can see here in this scenario, price returned back to it and bounced up. It doesn't happen every single time, but it does from time to time. And some old ones like this, price usually revisits them later. I don't know if price revisited this one later, sha. Let's see, did it? Yes, I think it did. It revisited this one later. You can see how price, if you're trying to buy off this, see how volatile this shit went. See, price revisited this one later. I just got there and threw weak. Are you seeing it? So yeah, that's how it works. That's how it works. So we have some other kinds of examples here, and I'll still show you some more examples of bearish order blocks. This is going to be bearish order block or supply. Bearish order block or supply. You can see it here. I see how price respected it later in the past, in the future. This is a bearish order block. It's crossed a break of structure to the downside. So the origin of what causes break of structure is this. That's the origin. So that's a bearish order block. Okay. What about this? This is a bullish order block. Remember, before you mark this order blocks, you must make sure you're drawing a high that this bull run had to run before the origin becomes another block. Here, before you consider a bearish order block, you need a low that this sell trend has broken for you to consider this a powerful area or a strong high or whatever. A strong high will always have the order blocks there. Okay, a strong low also have its other blocks there because it had the power to break above this high, so therefore it's a strong low. So you see other blocks around here too. So that's just exactly how it works. That's exactly how it works. So yeah, so One more example here. This is another bullish order block. This one played out, this one works. So don't bother. I'll say it again. Don't bother about how to use it, when to use it, blah blah blah. You have to finish the whole course and understand the strategy first before you start wondering when to use it, how to use it, and everything. Okay? You don't have to truly stress about anything you're trying to do. With it, you just have to calm down and understand what it is first, not how to use it. But these are areas where it worked out. Now, we would learn the concept of mitigation and failing of an order block. So, when it comes to an order block, it's either price mitigates another block or price fails another block. Mitigation is written like this. So one is successful and one is failure. So when you hear another block has been mitigated, is when price returns back to it successfully. And when you hear another block is failed, mitigated, if price returns back successfully to it and start respecting it, is mitigation. But failing is when price returns to it and does not respect it. Instead, price went deeper, lower than that zone. It has been disrespected. Okay, it has been disrespected. Now, in future, this one that was failed, if price fails an order block, automatically it turns to what we call breaker blocks. So breaker blocks are old failed order blocks. They can't turn to breaker blocks. Why? Because when the market pulls back later on, since it broke here and it has changed trend as a result of that. So if it returns back to here, it can fall more, because that is now called a breaker block. This is where it's changed the trend or change of character, whatever you want to call it. But the fact that it returns to area lights and drop is called breaker blocks. So now this was once a demand zone that failed, is a breaker block. It's not going to be turned to what? A bearish breaker block. It wants bullish demand will turn to what? A bearish breaker block. It's written with a negative. Negative stands for bearish. So in an example like this, the price is going down and price is supposed to return back to this supply, but then it failed. Instead of mitigating it, it failed. Now, this is an example. This is the supply and price what? Slided through it, it has failed. So automatically this has turned to what? A breaker too. But now, a bullish breaker. Why is it a bullish breaker? It's going to always be opposite. This was a supply, a bearish order block, but when it fails, it turns to a bullish breaker, because price will need it to push price higher. So if price returns back to it just like it does now, then we can see higher prices. That's why it's called bullish breaker block, because it pushes price higher. So you've been able to learn about order blocks, bullish order blocks, bearish order blocks. You've been able to learn about their synonyms, supply and demand. You've been able to learn about mitigation when price respects a particular order blocks. I have been able to learn about order block fail when price fails another block. I've also been able to learn breaker blocks when price is called bearish breaker and when it's called a bullish breaker. So it is a case where price mitigates a bearish order block. As you can see, this is an example where price mitigates a bearish order block. But then I'm looking for an area where price failed an order block too. So let's look at it. Here, price mitigated the order block here. As you can see, here price failed the order block. This is a bullish order block, and you see price wicked through it. Price did what? Price wicked massively through it. As you can see, price wicked massively through it. So it's not mitigated. It's a failed order block, as you can see. But price still reacted off it, but no, it has been failed. Price wicked it. So we'll look for more examples of failed order blocks. Let's look for failed order blocks. More of them. Especially the ones that price came back to and used them as a breaker. That's really what I want to see. Okay, so we have an example of a breaker here. A failed supply zone. This was once a failed supply zone. As you can see, it's a break of structure. And this is the last bullish candle before the aggressive move to the downside that broke structure As you can see, when price returned back to it after the first time, price went down. Price returned back to it, price went straight up and failed it. But do you realize that price came back to retest that same area and went higher? Price retests that same area, even if it's not perfectly, but it retests that same area and went higher. That is exactly how breakout blocks work. There are going to be more perfect ones, and we'll find them out. Okay, we'll really find them out. This is a normal supply zone that price just did not take seriously. Price slided through for a better one higher here. Now, when you're trading, you're not going to be having problems because price filled your supply. It means you're going to lose and the rest. That's not how it works. You don't trade like that. There are other confirmation we look for that makes you avoid these other blocks that won't hold. That's why you should need to continue the video so you can find out more things you need to know. So I'm just looking for more bearish bullish breaker examples. Okay, so that we can be sure. I can have a picture of it. Next picture of it. So we have a nice bullish bearish breaker here. So this is a breaker strategy to the upside, and this is an order block, right? What do you notice about the order block? As price traced inside, price failed it. So what happened? Price changed the trend later, broke through the downside, and retraced back into this box that was a breaker and dropped massively from it. So now one thing about breaker is that they don't stand on their own, or I don't even use them on their own. It must be in conjunction with another PD array. So what I mean is, in as much as I know price returning back here and it's a breaker, I'm also going to take this sell seriously because there is also a bearish order block inside. So the combination of the bearish order block made the breaker stronger. If not on their own, most times they don't hold or they don't behave well. But because of this other block that is still attached to the same area, then you can trust it to work even better. So that's exactly how it works. Okay, that's exactly how it works. So we have another example here of a supply zone that got snubbed. As you can see, that's a supply. Price failed it, and you see price retested it back before moving higher. This is a bullish breaker example. I've done a bearish breaker example. So if you found this video helpful, you know what to do. You have to do this homework. All right, so what's your homework? So number one, identify and screenshot 3 examples of failed bullish order blocks. Okay, or failed off. Let's put an off here, or failed bullish order blocks. Number 2, identify and screenshot 3 examples of mitigated order blocks. Okay. Now number 3, identify and screenshot 3 examples of failed bearish order blocks on any currency pair and time frame of your choice, making sure you present the BOS properly with a neat drawing on your trading view. Okay. Number 4, identify and screenshot 3 examples of mitigated bearish order blocks on any currency pair and time frame of your choice, making sure you represent the BOS properly with a neat drawing on your trading view. Now, if you notice, I don't look for bearish order blocks on an uptrend. Neither do I look for bullish order blocks on a downtrend. Bullish order blocks are only found it's not really only found, but you only look for them on a bullish trend, on an uptrend, so that you can easily find them. And you only look for bearish order blocks on a bearish trend, so you can easily find them. If you do anything contrary to that, you fail this, and it means you have not learned anything. So take your time, choose the pair of your choice, choose the time frame of your choice. I would recommend you choose time frames like the 15 minutes or the 1 hour, so you can easily identify. If you choose very higher time frames, it might be very difficult for you. So that's just the assignment. You do it after watching this particular video. See you in the next course video. So welcome back. FVG is just like an order block. It's used, but it does not look like an order block. Okay. So the use of FVG is the same way we use other blocks, but they do not look like other blocks. Why? Because FVG is just a gap in the candlesticks that has to be filled. So I mean a gap in the candlesticks. So we're going to look at every candlestick basically and see how they form. Let's look at them closely. So I'm starting from here. This candle. See how this candle was formed? Completely covered. It was covered at the back and at the front. What I'm basically trying to say that the nature of this candlestick arrangement is that they must be covered back and front. A candle must be at their back. It could be with a wick or could be with a body, but something must cover them at the back and front. Each and every one of them. That's the way they form. But there are certain abnormalities when you see some candles are not completely covered. Those candles are known as fair value gaps. So looking at the black one in reference, it was covered at the back, it was covered at the front, no space. This is the same, completely covered, all of them, all of them, all of them. Are you seeing? So now this is an exception. Do you see that? This is an exception. Whenever the candle is in an open space, there is nothing at the back and there's nothing at the front. It's known as what? A fair value gap. Why? Because later price will cover it or price will react to it and drop. So you see price covered it this time. Do we have another fair value gap? Yes. It's just on the air. No candle cluster at the back, no candle cluster at the front. It's a fair value gap. It later got covered. And you can see price will later cover it. All these candles came at the front and covered it. Okay. You have a fair value gap here too. Why? A candle covered it at the back, but partially. It didn't cover it completely. It stopped here. The gap remained. A candle came in the front, formed, and stopped in the front halfway. So there is a remaining part of the candle not covered, which is this, which I'm highlighting with this rectangle right now. Okay, so that's a fair value gap. Another one here, as you can see, is standing here. There was one at the back that covered it partially, stopped here. The one in the front covered it partially, stopped here. The remaining space is known as fair value gap. Look at the space in between. Other candles that are clustered do not have that. Okay, this one, are you saying the previous candle before it refuses to cover it completely? It left a space. The one in front refuses to cover it completely. So the space where this week stopped and where the previous week stopped, that space is known as a fair value gap. So how are they used? They are used like other blocks, meaning if you have price going in an upward move like this, price pulling back below the Fibonacci 50% is either coming to an order block or a fair value gap. Sometimes a fair value gap, sometimes an order block, and then it flies back up. The fair value gap is able to influence it to go back up. They're always found around here or so. That you see the same use of the order block. On the downtrend, the same. Price breaks down, retraces back above the red line fib to either an order block or a fair value gap and drop. Gets to either an order block and a fair value gap and what? And drop. So this is basically what price does sometimes. And another use of fair value gap is price sometimes will want to trade in the direction of a fair value gap. Okay, so if, for instance, this was a market and at this point, this trend changed right here. It was an uptrend before, it changed, and there was a fair value gap around here that was not tapped. Okay, just lying helplessly. price is likely to go chase it, to tap it. So we can use it as a destination to take profits for ourselves or anything, because when price get there, price will jump off. So that's why we normally take profit at such a point. So show you how it's being used. This is a nice example. I'm going to show you. So this low was taken out beautifully, and price had to retrace back to this fair value gap, mitigated the fair value gap, and dropped. When I mean mitigate, more like touched it. Okay, you see, I see the downtrend. We broke this low. Price did what? Come back here, slump down, neatly. Okay, neatly. You see this? Price did what? We trace back into the fair value gap here and fell. See this? Very good example here. Fair value gap was created, and then price, why the fair value gap was created, price broke this low. So for price to keep going down, it had to retrace back into it, enter the gap, and then fell. Okay. We have one fair value gap here too. You see, it's an uptrend market. So basically, price broke this high, retraced back down into this fair value gap, and went back up. See it, though it's went a bit lower to change this other block, but then it's covered it slightly. So let's see more examples. Sometimes price does not respect it, meaning price will just cover it, keep going up. Yes, it happens. Does. So we have one here. See, price broke this high, retraced back into this fair value gap here, and you see price went up. Perfect example. Did you see that? Perfect example. Instead of price to come back to the other block just from the fair value gap flip. So like I told you, they play roles of other blocks sometimes. See here how price broke this high, created a fair value gap, returned back into it, and then went up. All right. So this is basically how fair value gap works. So if you found this video helpful, like and subscribe to the channel. More content coming out. Peace out.